MSA performed pretty well in 2009. We had a lot of significant accomplishments. Probably the most significant was adding probably about $85 million to surplus, which brings our surplus up to about $692 million, which is just a fantastic achievement. We also, our return on equity is 18.2%, which is a really terrific number. And our combined ratio, while it didn't quite hit our plan of 97, it came pretty close at a 97.4. So all of those key financial accomplishments will put us in a very good position against the industry. And aside from that, I think probably one of the greatest things that we did as an organization was continue to take magnificent care of our customer. We continue to hear when we talk to our customer why they give us business. It's not usually price or product. It's always they name somebody. It's always somebody that they have a good relationship with that's doing everything they can to help them in their livelihood. So that's, I think, a great part of our culture, and it continues to was a great accomplishment for us last year. What a difference a year makes. You know, last year, if we think about where we were this time last year, the financial markets were in turmoil, and the future was fairly uncertain as far as what direction things were going to be heading in. We were coming off a year where we had a terrific combined ratio of 94.9, and we expected to be able to continue to do well this year. The unknown really was the financial markets, and particularly early in 2009, the financial markets were still in a bit of a turmoil. I think for the stock market, the low point occurred really in early March. What drove our fantastic ROE is we almost hit plan on combined ratio at a 97.4, so we were able to generate some good underwriting income. But what really drove it was the investment results. The good news is the combined ratio ended at a 97.4, and that, again, a terrific result compared to the industry. That was driven primarily by commercial lines. Commercial lines will finish at a 92.5. The bad news is all the other profit centers were over their plan. Personal lines was around a 102. The assumed reinsurance was around a 102. And bonds, unfortunately, with some of the issues in the economy, finished at about a 109. So we really kind of lived off of that very good commercial lines result. And we also had a storm year that was a little bit lighter than historical. We allocated about 2 points for catastrophes, and we used just under 1 point last year. So we did have some storms, but we were fortunate not to have too many. From a regional standpoint, the real stars were Jacksonville and Syracuse. Jacksonville's combined ratio was very good, again, in the 80s this year. Terrific result. Of course, a lot of that is Florida, and we do underwrite to a much better combined ratio result in Florida, and we expect to have these kinds of results when we don't have big hurricanes. And then Syracuse also finished underneath their plan. They were somewhere in the 94 range, which is, again, a terrific result for the states in New York and Pennsylvania. The other two regions, New England was a little bit over 100. They started out very poorly and have been able to get better month by month over the course of the year, but they were not able to quite get down to their plan number. And then the Richmond branch also was over their target as well. As far as premium is concerned, again, good news, bad news here. The bad news is we did not hit our premium plan, and that has a lot of repercussions. You can see from our OOE ratios, which also was on sort of the bad side of the ledger. Expenses really did go up again in 2009, and a lot of it is the pretty significant premium shortfall. On a net basis, we actually grew, which is going to be, again, compare very favorably to the industry. The industry is probably going to be down about 3 or 4%. Our net growth will be a little over 1%. Against a plan of around 5 or so. The last 2 months of 2009, November, December, both commercial and personal lines had positive growth. And we're hoping that's a sign of a signal of what's really to come throughout 2010. You've heard me say this before, that the most important thing for us, and not only commercial but in personal lines, is to protect profit. Commercial lines, that was very difficult this year with a lot of companies very irresponsibly pricing their products, and our underwriters were under a lot of pressure. And I think they did a very nice job in managing to keep the accounts that we felt we could get the appropriate price for, and in those cases where competitors were irresponsibly pricing it, thanking our customer, but moving on. Our balance sheet is very strong for the organization. As I mentioned earlier, our surplus is going to be somewhere around $692 million, and that's up from $607 million a year ago. A year ago, we were doing everything we can to keep our surplus above $600 million, given the financial market turmoil and the difficult economic conditions. And a year later, to be almost at $700 million is really a terrific result. And the fact that we really didn't grow much, 1%-ish kind of growth, our leverage ratio actually has improved. We're slightly under 1.2 to 1. And I also might add that our reserve position is extremely strong and very stable as well. When we put everything together, we have a really very strong balance sheet, which will allow us to continue to make the kind of investments that we need in products and technology and people. It also is going to give us some great opportunities around merger and acquisition and affiliations. We now have more, let's say, capital to be able to pursue affiliations and alignments, also have the capital to perhaps do some acquisitions, which is something that we've been pretty successful over the last couple of years doing acquisitions, affiliations, kind of special deals, if you will, with certain independent agency groups. That, I think, will continue. We're seeing a lot of particularly smaller mutuals that are a bit hobbled right now, that either don't have the capital to invest in the kind of technology that they need, or the predictive models from an underwriting standpoint, or their investment portfolio have taken hits. So there's a lot of distress out there, particularly among the smaller mutuals, and we are getting some pretty good looks at things.